This is the DeFi Decoded podcast by 9 Point Partners in cooperation with Prophecy DeFi. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hey everyone, this is Alex Tapscott. You're about to listen to this week's episode of DeFi Decoded. We had a very special sort of thing happen on this episode. About 10 minutes in, Mike Belshe, the CEO of BitGo, one of the largest crypto asset custodians in the world and one of the most well-regarded and well-respected executives in the space, hopped on the call. Originally, he was supposed to come in maybe for a couple minutes, but he ended up sticking around for 20 minutes or so and gave a masterclass in how to run a successful company in the space and some really keen insights on what's going on with FTX and where we go from here. So I think you're going to really love this. Make sure to just stick around for the first few minutes. Andrew and I chat for a bit, and then Mike hops on. Thanks a lot. Enjoy the episode. Hello, and welcome back to another episode of the DeFi Decoded podcast. I am Alex Tapscott, here with co-host Andrew Young. Last week, we had to re-record the podcast because events were moving so quickly. The podcast itself, I think, was recorded on Tuesday, came out Wednesday evening or Thursday morning. I think it was still relatively useful for some people, but things were moving so quickly, it was frankly hard to keep up. Things seem to have slowed down a little bit on the FTX situation. On Thursday, we had news that FTX, its US subsidiary, and all basically related parties had filed for a Chapter 11 bankruptcy protection. I think it seems as if SBF, the CEO, is still scrambling for some kind of a rescue package from a competitor or a group of investors. That is looking extremely unlikely at this point, given the quantum of the whole, anywhere between sort of $6 and $10 billion. On a business that at its peak, I think, had around $18 billion of customer deposits. So just a staggering mismanagement of customer deposits and potentially some very serious wrongdoing as well. Andrew, let's talk a little bit about where we're at in this whole situation. Maybe not getting into the gossipy nitty-gritty of what's going on in Bahamas with SBF and all the rest of it, but what's the impact here on the broader market? How are you feeling about it right now?
Yeah, so just a couple updates, I guess. FTX announced bankruptcy on Thursday, and we got the first signs of contagion on Friday when BlockFi announced that the majority of their deposits were actually on the FTX platform. So they had paused withdrawals, and it looks very bleak there in terms of whether things are I mean, FTX was sort of the savior of BlockFi. So the fact that they, as part of the agreement from FTX to buy them, was that they had to keep their assets on FTX. And so now that FTX has sort of gone under, it looks like BlockFi is likely toast as well. We also saw a number of funds impacted. Multicoin Capital, for example, said that about 10% of their assets were on FTX. They were actually able to get 24% of their assets off the platform just before it went sort of insolvent. So they sort of could have been even worse for one of the biggest crypto hedge funds in the world. Ikigi, which is this relatively large crypto hedge fund, they actually kept the majority of their assets on FTX. And so that's obviously very tough for them. And we also saw Galoy Capital as well said that they had up to 50% of their assets on it. So the contagion has been pretty crazy and relatively widespread. I'm actually a little bit shocked, and I think a lot of people are as well, that the crypto market has performed as well as it did. Ether is only down about 15% from where it was about 10 days ago when it was at 1,300. I think right now we're at around 1,200, and we had a low of about 1,100. And I think part of the reason why is the macro backdrop has turned quite bullish over the last week. We had a relatively soft inflation number, and obviously the stock market has been doing quite well. And within the stock market, the sort of most high beta risk on assets have done even better. And so I think a lot of people are obviously happy that crypto has been able to weather the storm, but also a little bit sad, I guess, the fact that a lot of people, I think, that Ether, for example, would be above 2K right now if this whole situation hadn't happened, and we'd be sort of in the early innings of a new bull market. Whether that's true or not, we'll never know. But I'm curious what your thoughts are on the situation, particularly with.
Yeah, you've raised a bunch of really interesting points, especially around the question of contagion and the kinds of risks that some of the counterparties to FTX have taken. We're really fortunate, Andrew, because I was texting with Mike Belshe, the CEO of BitGo, moments before the podcast, and he very graciously agreed to just hop on for a few minutes to share his perspective on what's going on out there. BitGo, for those who don't know, and maybe for folks outside of the crypto space, is one of the largest custodians of digital assets in the world. I'm not sure what the number is now, Mike, but the last time I checked, it was over $10 billion US. It's a company that's been around for a very long time. It has a great coaching tree, similar to sports. A lot of really smart people got their start at BitGo and have gone on to do lots of really amazing things. And BitGo today, I think stands as one of the most reputable, most respected kind of firms in the space, and one that's been kind of at it for a long time. So, Mike, thank you so much for hopping on. Andrew was just talking a little bit about some of the knock-on effects of the FTX situation. But before we get into the details, how are you? How are you doing? How's the past week been for you?
Thanks for all the kind words. And you're very gracious to have us on your show. Well, let's see. It's been a hectic week for sure. Tons of questions. Everybody's calling and saying what's going on. People are trying to get market color. This is kind of what happens in these types of situations. I think everybody was pretty shocked, surprised. We saw that Alameda's balance sheet was ugly, when CZ, started tweeting. I think it was a little over a week ago now. And initial expectations like, Alameda might have blown up. But I think nobody really anticipated that the level of crime that must have occurred at FTX in terms of it blowing up too. So I think it was Wednesday or Tuesday when it was announced that, sorry, we had to get bailed out. Anyway, so tremendous shock. And so many people are just like, who can we trust in this industry now? I don't know. BitGo seems pretty good, but who's that guy? Brian Armstrong, I like him, but who's that guy? We thought we liked Sam too, right? So definitely we have a lot of work to do in terms of restoring trust. In terms of how the markets are doing, I actually also agree with Andrew a little bit. I'm impressed that the markets haven't been in worse shape. Now, I do think there's going to be some more shoes to drop. That seems to be the general prevailing wisdom. I think there's probably discussions going on to bail some out, which may be why we haven't heard anything just yet. But those only last for so long before pressures mount. So we'll see what happens. And there could be a little bit more downside from there. But the long-term picture that people are thinking about, everybody's still really bullish on what we're doing with digital assets. So there's been no retreat on that front. Now, for institutional investors to invest, there is definitely a pause. People are like, wait a minute, I need to know how I enter this market safely. So, I'll selfishly talk my own thing for a second. For about the last 5 years, I've been talking about market structure. And, it's not always obvious to technologists what market structure is or why it's important. It does seem to get in the way, slow things down, create what we stereotypically consider to be, laggard banks and things like that. There's some truth to that, but it's not entirely fair to just blame the existing industry for everything being bad. But we need checks and balances. We started as a kind of a security company. How do you secure assets so that you don't lose them? In the early days, it was technology principle, but as we look to build the market properly, there's a lot of overlap between what security means and what regulation is intended to mean. And with the help of the technology that we ought to be able to come up with a really good combination. But clearly, we can't allow what happened at FTX to happen again. We've, I think, been pussyfooting around, not going most aggressively enough at really fixing the problem. So there's a few players that are starting to separate things apart. There's a few players that are getting regulated. We just got to stop this nonsense so that we can start moving forward with confidence. There's a lot of good people that are working in this space that want to make good products that help, their clients in a completely legit way, not trying to commit crimes and things like that. We just need to go more aggressively.
Great points. Thanks, Mike. I have a couple of follow-ups on that. So one of the sort of sad ironies of the situation is that, crypto assets are peer-to-peer technologies, right? Blockchains are decentralized ledgers that everyone can trust without needing some middleman to, keep the books straight. And yet, throughout the growth of this industry, we've come to rely a lot on these centralized exchanges. And it's almost like entities that were supposed to be on-ramps to the industry kind of became the industry. And my hope, I think, is that, on the back of this, that there's a renewed focus on decentralized solutions, right? Whether they're decentralized exchanges or DeFi projects and the like. And I hope that they're also built to solve simple problems for a larger swath of the population. I think there was like a focus on sort of capital markets like applications initially in DeFi, and I think that there's a lot of greenfields in financial services generally. So that's sort of my view. But at the same time, it's naive to think that there won't ever be trusted centralized parties in this industry. And I can just speak from personal experience. At 9 Point Partners, we have a Bitcoin ETF. By law, we need to custody our assets with a third-party custodian that meets a variety of criteria, for example. And lots of other institutional investors and other parties need a similar kind of arrangement to feel that they are investing in this space responsibly or using the technology responsibly as well. So for parties like BitGo, who have, in my view, held up a high standard for the industry, what are the biggest recommendations that you could make for some kind of industry-wide set of rules? And I'm not saying necessarily that they're government-imposed regulations per se, but what are the best practices so that this thing doesn't happen again? To your point, like what can we do to ensure that the institutions that hold assets, that hold private keys on behalf of others, that are acting in this trusted manner, to stop this kind of thing from happening again?
Yeah, well, first off, let me echo your sentiment about decentralization. It's going to take us a long time as an industry to be able to carry humans that are frankly not very good at holding key material to a path where you can really do that in a routine part of your life without any concern. It's going to take some time.
I completely agree.
I'm wholly in favor of that. And BitGo's got this whole business where we started. It's the wallet as a service business. It's 100% decentralized. You own your own keys, et cetera. I also get a fair number of questions about Wrapped Bitcoin, which is a centralized service we offer where we hold the underlying Bitcoin. It's effectively a stable coin of Bitcoins. And people criticize it because they say, well, Bitcoin, yeah, okay, that's true. But people shouldn't really be holding wrapped Bitcoin unless they're using it. It's kind of like, taking your money off of exchanges when you're not using the exchange. So for folks that know how to hold their own assets in a decentralized manner, absolutely do that. And if you're using, an exchange, get in and off the exchange as much as you can. If you're trading all the time, that's hard, but a lot of people can move off of the exchanges and they just don't do so for convenience. Similarly for wrapped Bitcoin, of course, if you're using your wrapped Bitcoin and you've got it locked up in DeFi contracts and places, you're using it, so you can't. And then you've got, yes, a centralization risk, but you're getting a benefit, right? And the hard part that we have is, as individuals, is measuring the risk rewards that we're taking. Anyway, so first off, decentralized, yes, as much as possible. Now, the second part is, how do we make digital assets usable across the globe by everyone? And the fact remains, and you pointed out, your company is heavily regulated because you're managing money on behalf of other people. So if it's my money, I can put it in the closet, I can put it in my pocket, I can do whatever I want with it. It's my risk, it's my money. However, if I'm managing someone else's money, we've always held a higher bar. And obviously that applies to you with financial services products, but it also applies to businesses. Like, what if you just want to get paid in a particular, digital asset? Maybe it's even just simple USDC. Do you just give the private key to the IT guy and say, hey, can you manage the bank account for me? No, of course not. You have a whole access control. Now, we can move much of banking to be more decentralized than it is today, but business continuity does require some amount of, hey, how are you going to recover if the individuals that are currently at that business are no longer at that business? Maybe they, unfortunately had a demise, or they quit, or, normal, ordinary course of the day types of things that happen. So that's what the decentralization versus centralization sometimes misses, is that holding your own money, decentralization totally possible. Holding other people's money, not possible. And then the last overlaying piece is that, people keep losing key material. We're just not good at keeping secrets. We see this over and over again. Even technologists do it. I think you saw the Axie Infinity hack a few months ago, and they picked good technology. They were using a Gnosis safe, nothing wrong with that. But they had a bunch of keys on a single machine. Oops. It was operational security that failed them. And whether we're talking about individuals or technologists, humans tend not to be very good at that. So when you put it together in a fiduciary custodial manner, you spend a lot of time on really boring operational controls. All right. So how to fix this problem? Look, there's a number of pretty much everybody, I guess you'd say, is trying to suggest things to do. You heard a lot of advocacy for proof of reserves. Love proof of reserves, and that it provides transparency. However, it's not adequate, and it's in part because we live in a hybrid fiat digital world. Difficult to do proof of reserves on the fiat side. Now, we could go full stablecoin, in which case we can then split the problem. First, you'd have the audit of the stablecoin, and if you're satisfied that that's being done properly, that they've actually got the backing that they say they have, then you go to a full digital to digital proof of reserves. That would look pretty good, right? So, wrap Bitcoin, by the way, does exactly this, because the Bitcoin is digital and the wrapper is digital. We can actually verify that those two add up, and you can go to WBTC network today and you can see that. But then lastly, the piece which I think is most troublesome that hit FTX is lending and leverage. And it seems like as soon as you bring humans into financial services products, we just have this need to gamble and lever up. And now you've got liabilities. Okay, so liabilities don't work in a proof of reserve system. You can't prove that there's a non-existence of a liability, right? The only way you could do that is through, human manners. Now, maybe we could get to a blockchain that tracks all liabilities and everyone uses the one true liability blockchain. I think that's far away. I think we need to take interim steps that are going to be stronger and are more practical, I should say. And this is where audits and verifications do come in. Now, I think audits are not the greatest. I'm not saying I'm in love with audits, but clearly you need to have other eyes looking at it. So this is where we've been talking about market structure. Can you separate the duties a little bit so that look, security and storage of asset is a set of skills and expertise that gets built up, which is very separate from building, retail exchanges. So you can spend your entire day working on and building exchanges that grow large, massive amounts of users and providing, new products and services there. And are you able to also simultaneously focus on good separate storage? Maybe. We've seen this fail a lot. So I think that's a separation of duties. And if we do it right, we can make it so that the separation of storage actually does provide bankruptcy remoteness from the trading party, which I think is really what we're looking for. And so that you've got, ongoing accounting that can happen, that can verify that the assets match on both sides, or at least have two places to look and say, how much do you have? You got 5 million? Okay, how much do you have? Do you have 5 million? So that should be doable. At the risk of going too long, I'll just say one more thing. So BitGo provides bankruptcy remoteness today, but this is where I think the entire industry just needs to move a lot further. We provide basically bankruptcy remoteness from BitGo going bankrupt. Well, so if we die, great. Our clients are happy that, their assets, they'll get it back relatively quickly because they've got segregated assets and it's all accounted for properly. What we wanted in this case was we wanted the end users of FTX to have bankruptcy remoteness from FTX. And in order to get there, we have to do a much deeper integration of market structure where all the way out to the custodial banking partners, we know who the ultimate owner of the assets are. And that's going to take a little bit of work. So Yeah, and then I guess one last thing we can do, off exchange settlement. Frankly, there's really no reason to have custody of assets at exchanges at all. This pre-funding is a unique thing to the way crypto evolved, but there's no other asset class that trades this way. This is actually an area that we're working on right now. I mean, we have a product here, and now we're trying to use it as an opportunity. The exchanges have generally gotten more favorable about doing this, but they're busy. Biggest constraint in any crypto business today is usually resources for development, and they try to judiciously pick the things that matter the most. So anyway, I would advocate for separation of custody from trading and other types of activities, building out market structure, and getting assets off of exchanges, both by individuals choosing to do so because they can, but then also by building a market structure that just doesn't require it.
But Mike, I guess right there, that's the perfect sort of billboard for decentralized exchanges in terms of separating custody from trading itself, which is obviously, like you said, how sort of traditional markets work. You don't actually commingle the two the same way that obviously centralized crypto exchanges work. I'm curious, how do you see sort of decentralized exchanges playing a role in this? Obviously, like you touched on a lot on how centralized exchanges can get better and things like that. But I'm just kind of curious, is DeFi the answer, or yeah, I'm just curious.
Yeah, well, I'm a big fan of the DeFi markets. Look, I think the DeFi markets they're in their early days, so they have some weaknesses on their own, which just need to be fixed, right? So getting to institutional grade will take some time. Even getting to scale grade is going to take some time. I mean, you've probably seen, between miner extractable value, some of the privacy that you get, there's some things that kind of prevent it from working super well. There's also some compliance things that need to be figured out. But I have no doubt these are going to get solved kind of on their own, which is great. I roughly think that the DEXs are not quite ready for prime time today. And I don't know if I'm being too critical there, but I think they're all evolving in the right direction. A slight correction, you're correct that the traditional finance markets don't have centralization of custody on them, but they very much have centralization, and they have a whole bunch of credit risk that exists, basically between the brokers that interface the exchanges and not. So DEXs are strictly better. And then for the business world, businesses will still need, again, to go through some sort of intermediary to access the DEX. And the reason is because of the business continuity thing we were just talking about. If you're a business, if you're Alex, it's other people's money. Alex can't just take custody of the other people's money, even if it's only instantaneously for a trade. So we need a market structure there where there is somebody that's holding that and interfacing to the DEX under his command, of course. But those rails, we haven't really hit yet. So anyway, I very much like the DEXs as part of the solution here. I think privacy is probably transaction privacy is the one thing I would love to see most in order to get that going. There will be a compliance element. There's a few of the DEXs that end up kind of creating accidental mixing pools, which I know they're not intended for bad use, but it creates compliance questions that are just really difficult for larger money flows to be able to participate in. They just can't handle the reputational, legal, or compliance damage that could come from interfacing with those types of products.
I find that there's two things that can occur simultaneously in an ideal world. One is where you have privacy for the individual, but also transparency for the system or for the platform itself. Because what we like about things being on chain is that you can see the flow of funds happening in real time. There are limitations to this on-chain analysis and audit, to your point. I like that expression that you can't prove the non-existence of a liability, but you can prove a lot of stuff. There is a lot of ways to sort of gather information, but sometimes that comes at the expense of doxing wallets and exposing people. And I think for a lot of businesses specifically, that's sort of a non-starter for DeFi, is that they have to be able to have some reasonable expectation of privacy in transactions. You can imagine a scenario where this technology extends to other assets like stocks, and the company is trying to, a fund manager is trying to take on an activist position in a, stock, needs to be able to sort of do so discreetly. There's lots of other examples of why you need privacy in transactions. But to me, it seems like there, to your point, Mike, they're not reasons that, decentralized exchanges are a bad idea or that they're not going to fulfill that role. They're implementation challenges that need to be overcome. And so it's a matter of building them out so that we can overcome them. But in the meantime, what is the solution? And actually, just to clarify what I'm saying, I'm not saying that trusted custodians and other third parties are some kind of a stopgap between some decentralized future. And if anything, I think of them as being like integrated into that future in a really important way. I can see, integrations between all sorts of different companies, businesses, vendors, and so forth, and that decentralized base layer infrastructure where all the trading is actually occurring.
Well, I mean, just one last point on custodians. I mean, and I'm a huge, I would love it if we could make everything decentralized. I'm not trying to push that way at all. I just think it's an inevitability. So imagine it this way. Imagine we had, it's an all digital world now. Every stock, every bond, you got Bitcoin, there's no more fiat, it's all gone. And it's this wonderful digital utopia. So all of your assets are digital. Would you want to hold all of your assets yourself? I'm guessing the answer is no. It's easy to say, hey, look, it should be decentralized when it's a relatively small amount and I'm going to hold it myself.
Yeah.
It's also fairly easy for, certain technologists and cypherpunks to say, hey, I can do that. But for the masses, even though we will definitely make the technology easier to use, even though we will make it more secure, we'll make it more resilient against different types of common failures, you want to make sure that it absolutely gets passed on to your kids, should something happen to you. You absolutely want to make sure that you can't get mugged or have somebody come into your house and steal it from you. And these are fundamental properties when you are the direct custodian. So I just think there's a custodian world out there that exists. Yeah. But what we're building is this place where you get the choice. You can put this part of your assets and portfolio into a more centralized leaning, and maybe you get some benefits from that. And you can put this other part and you can participate directly. And it doesn't matter which part of the globe you're in. So the openness and transparency solves a whole bunch of things, but people are going to still opt for this choice. I've seen very wealthy people being very, very nervous about really modest amounts of Bitcoin to be held by themselves. Yeah. They're just afraid they're going to lose it and they don't want to. Everybody's got their own risk tolerance. Some people you've met are very aggressive, some people very, very conservative. So yeah. I just see that as inevitable. But yeah, the DEXs are absolutely coming, and it's fabulous technology. I think also the lending platforms are fabulous. But again, to the liabilities and the and whatnot, that's a little harder part, because if you use the lending platforms in DeFi, you generally can't get leverage, and that's because they have to be able to be self-sufficient and self-contained. So it's got 100% backing. We'll see if people can figure out a way to do leverage there. I think I would be scared of that. So I'm not sure I want to see that, but I suppose it could come. So somebody's going to introduce leverage externally. And then we need to make sure that that leverage is applied in a contained way where people know where that risk is. So it's not buried in the fundamental systems that are supposed to be reserved.
Yeah. So I hope we can keep you on for just a couple more minutes. A question, yeah. Binance is talking about some sort of plunge protection team rescue fund that they're going to help to, get rolling as a way to sort of underwrite any failures in the industry. And on the back of this, I think Binance is at 50% of trading volume, and BUSD, their stablecoin, has been rapidly gaining market share. I'm just wondering, are you worried at all that we're sort of becoming more concentrated in the hands of a single company in terms of the value that's traded hands in this industry? I think that we went from a handful of celebrity CEOs and personalities maybe down to one, and that seems like even more worrisome. It's fine now, I guess, as long as everything's operating, but in the long run it seems like antithetical to what we're trying to do here.
Look, I think given what's just happened, and by the way, I think Binance and CZ, I think they're good actors. I don't have anything against them. I think we're now in a world where we all recognize we need to trust but verify at a level of depth that we didn't. Actually, if there's one group that I would criticize for the FTX fiasco, it's really the investors. We saw it at Theranos as well, where sometimes you end up with a charismatic, CEO founder, or, some interesting story that gets humans' guards down and like they just stop doing diligence. Do you have a CFO? Seems like a checklist type of item, and we all learn
directors, a single independent director.
Yeah, and for those of us not doing diligence that didn't invest, of course we haven't looked carefully to see what it is, but apparently, yeah, we can't, just because you got a bunch of, big name investors doesn't mean they didn't drop all diligence. So, but anyway, back to Binance. Look, I generally think that they're good. And I think now the onus is on, both CZ and Binance, but also the industry to help make sure that we are, getting a little closer examination as to like, what can we trust? What's the right level of risk that we can take on any of these? Now, in terms of the kind of the central, the one winner that's so big, remember marketplaces tend to lend themselves to monopolies.
Right.
In a way, technology platforms have too over time. We've seen a number of monopolies in the technology space over the years. It's because, people, aggregate together. The best place to buy is where you've got the most sellers. The place to sell is where you got the most buyers. So to some degree, at the exchange is going to likely be a monopolistic type outcome. Most of the exchanges that have been in the space have been acting more as broker dealers actually than true liquidity venues. And you can see this in traditional finance too, right? CME, of course, is clearly a monopoly exchange. Been around for 100 years, I guess now. I don't know.
Yeah.
But
there's an argument with DeFi that we can have not only composable applications, but composable liquidity at some point. And, the idea that there is a single venue for anything where the most buyers and sellers are is almost redundant because we have a global pool of liquidity connected through all these different applications. That's the promise. The reality obviously is way more complicated than that, namely that the whole industry is fragmented across a variety of different chains, and our only solution to that are bridges, which can be risky. And there's other, there are other issues as well. So, like at least in the meantime, that dynamic of concentration seems to be true. Andrew, did you have any other questions you want to quickly get into Mike? Because I know you've got to hop off, and with Mike, we've been generous with your time too. So
I got to hop in a second too.
Yeah.
Yeah, no worries. Yeah, first of all, thanks for hopping on. It's been a crazy week, so it's been hugely helpful to get your take on it, sort of seeing it from the front lines. I'm curious, I guess, what do you think about, there's a number of kind of new, I guess, technical solutions for self-custody. So products like Fireblocks, Gnosis Safe, things like that, things that allow you to sort of use a multi-sig for custody. I'm just kind of curious, how do you guys see those as, I guess, not potential competitors, but how do you see, I guess, the custody space more specifically evolving over time? Do you think we enter into a world where, at least on the retail side, people self-custody, or are we always going to be dominated by kind of retail-facing centralized exchanges?
Well, let's see, real quick, on the competitive element, I'll try to get away from that, but BitGo's had the non-custodial wallet as a service platform longer than anybody. We've been running it since 2013. Fireblocks doesn't offer anything new above that. We started out with multi-sig as our core tech, and we pioneered that. They pioneered, I think, the MPC, or maybe they followed Curve and Unchained and some of those guys. But BitGo today has, full MPC as well as multi-sig. In fact, it's kind of fun. You can go and create an Ethereum wallet. You can say, I want multi-sig, or I want MPC. And, other than the setup of the wallets, otherwise functions exactly the same. I do think the MPC providers in particular need to be scrutinized a little bit more on the technology. BitGo is happy to have folks look at what we do and the model that we use. I think it's important to be transparent with where the key shares are. Some of the folks that are offering wallet services will sometimes say, hey, there is no key. Look, there's key material and you have to keep it safe and secret. You have to plan for backups. These are hard problems. Anyway, so if you do want that wallet, come to BitGo. I think we will continue to see retail get better and better. I think the younger generation is going to inherently learn from a young age how to deal with computers and private key material in ways that the older generations didn't. The technology will get better. The ability to have hardware protections kind of on everything, whether it's our phones or specific computers, will be very, very easy. So it'll get better, but I still think there's going to be this hybrid world. Business needs business continuity, so you end up having to have some amount of centralization. Now the decentralized technology weighs into that, and it's not like it's completely lost, but it is where you have to kind of give up some amount of control for trust, and that is a danger point. So this is where we start to get into these areas. Okay, like what else is going on? How do we know that you're safe, solvent, honest? And those are still the hard problems. Humans, unfortunately, are terrible beings, and we lie. Yeah, we got to overcome that.
On that uplifting note, no, in all seriousness, Mike, this has been an amazing discussion. We're so grateful that you were able to hop on and stick around for half an hour discussion.
All right,
I learned a ton.
Great to see you guys.
Yeah, yeah. Well,
there's so much to do. The best is yet to come from the entire industry. I love this industry because it's so innovative, and everybody from college students through the veterans in the space are all continue to just change, and some of that'll work, some of it won't work, but overall, when we come out with amazing products, and DeFi, I think has been just a huge, boon, even though it's early days. Just fantastic.
Yeah, agreed. All right. Well, thanks again, Andrew. Thanks for your time. We'll see everybody on next week's episode of DeFi Decoded. I'm Alex Tapscott. Take care. Bye.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.